Hello my dear students. Now in the booster series of lectures, let us start with the next chapter, Pgbp. I know you all will be feeling how much lengthy Pgbp is and how much complex this Pgbp is. So I am going to simplify this Pgbp chapter for you. Let us start. Minimum 18 to 12 marks you can expect from Pgbp chapter. In examination, first and compulsory problem in income tax is total income problem. In the total income problem, majority of the adjustments you can see from Pgbp head. That's why Pgbp is very important. Another thing is, quite often in MCQs also, Pgbp can be tested. So very much important head of income, very much important chapter in income tax. So listen carefully from start to the end, you will get best benefit out of it. You can understand the concept and you can start doing the problems. Shall we start? Yes. What are the sections that are covered under the head Pgbp? Section 28 to 44. These are the sections that are covered under the head Pgbp. Sir, what is the charging section? Charging section is section 28. Sir, as per charging section, which incomes are taxable? Here I have given the list. You can see total 10 incomes are chargeable under the head Pgbp. I am going to discuss with them little later. Next, sir, on what basis income is taxable under the head Pgbp? Income is taxable either on accrual basis or on cash basis, as may be followed by the SSC. Are you able to understand? That means if SSC follows accrual basis of accounting, for Pgbp income calculation, we use accrual basis. If SSC follows cash basis of accounting, for calculation of Pgbp income, we follow cash basis. So we can follow any method that is followed by the SSC for computation of income under the head Pgbp. Next, sir, what are all the incomes taxable under the head Pgbp? As per charging section, section 28. Now let us see. First of all, any income that is received out of business or profession, that income is taxable under the head Pgbp. Profession includes vocation also. Sir, what is the difference between profession and vocation? For profession, there will be formal learning. Profession is always backed up by some educational background or qualification. Vocation is not like that. By doing an activity continuously, an individual gets a skill over that activity, that we call as vocation. Are you able to understand? Let's say singer is there. If he takes formal training and gets degree, then we call it as profession. Some of the singers are there, they do not take any coaching, they sing naturally and they practice it. Okay. Likewise, soothsayers, priests are there. Next, astrologists are there. Okay, by practicing something over a period of time, they get skill over it, and that we call as vocation. Are you able to understand? So out of profession, including vocation also, if any income is received, that income is taxable under the head Pgbp. Next, compensations. This you will not understand straight away, so I will take one example. Tata Limited is there. MRF Limited is there. You all know MRF Limited is a tire manufacturing company. Tata Limited entered into agreement with MRF Limited. As per the agreement, the terms and conditions are like this. What are the terms and conditions? Tata Limited will purchase 1 lakh tires from MRF Limited after 1 year. After 1 year, Tata Limited is not in requirement of 1 lakh tires, because for Tata Limited, production got reduced. When production reduces, tires requirement also reduces. So Tata Limited after 1 year wants only 20,000 tires. As per the terms and conditions, Tata Limited is required to purchase 1 lakh tires. But whether Tata Limited is willing to purchase 1 lakh tires? No. Now what Tata Limited is doing? Tata Limited is modifying terms and conditions and reducing 1 lakh tires from 20,000 tires. Whenever Tata Limited modifies the contract, immediately MRF Limited will go to the court. Sir, Tata Limited agreed with me to purchase 1 lakh tires, but now it is modifying the agreement and asking us to sell only 20,000 tires. So immediately MRF Limited will go to the court To prevent MRF Limited from going to the court, Tata Limited pays 80 lakh rupees compensation. Why 80 lakh rupees compensation was paid? Because Tata Limited is modifying terms and conditions of the contract. Okay, it is reducing terms and conditions from 1 lakh tires to 20,000 tires. So for modifying terms and conditions of any contract, if any compensation is received, that compensation is taxable to the recipient under the head Pgbp. Are you able to understand? This is case 1. Case 2. For example, Tata Limited is about to close car manufacturing business because it is getting losses. In that case, Tata Limited does not want 1 lakh tires after 1 year, right? So Tata Limited is cancelling the agreement, terminating the contract. So for terminating contract, Tata Limited is paying 1 crore rupees compensation to MRF Limited. Even this 1 crore rupees compensation is also taxable to MRF Limited under the head Pgbp. Are you able to understand? Very clear. Any compensation that is received. Why compensation is received? Either for termination or for modification of terms and conditions of any contract. So for modifying or terminating terms and conditions of any contract, if any compensation is received, that compensation is taxable under the head Pgbp. Are you able to understand? Now I explain the case of terms and conditions. Not only terms and conditions, if any agency contract is either terminated or modified, for that if any compensation is received, even that compensation is also taxable under the head Pgbp. Next, management contract. With regard to management contract also, if it is modified or if it is terminated, for termination or modification of management contract also, if any compensation is received, then in the hands of recipient, such compensation is taxable under the head Pgbp. Are you able to understand? Next, see, only compensation amount is taxable under the head Pgbp. If interest income is received on compensation, that means like 80 lakhs compensation, along with 80 lakhs compensation, on 80 lakh rupees, interest at the rate of 12% was paid. Now, interest on compensation is not taxable under the head Pgbp. Interest on compensation is taxable under the head income from other sources. Are you able to understand? Good. Any compensation received due to vesting of management of a business or property in favor of the government. Let's say I am running one business. Now, government wants to manage my business. What I did not sell my business. I did not transfer my business. Whatever the managerial operations are there, okay, just management of my business I gave to the government. So whenever I vest management of business to the government, and for that if I receive any compensation, that compensation is taxable to me under the head Pgbp. Are you able to understand? Next, income derived by any trade, professional or similar associations from specified services rendered by them to their members is taxable under the head Pgbp. What do you mean by this? Best example for professional association is ICAI. You know ICAI, right? Institute of Chartered Accountants of India. So ICAI, who are its members? Chartered accountants are its members. For providing specified services. If any fees is received, that fees is taxable to ICAI under the head Pgbp. Best example, recently budget came. With regard to budget, one seminar was conducted by Vijayawada branch of ICAI. I attended that seminar. I paid 500 rupees fees along with GST. That means what? Here, Vijayawada branch of ICAI, it is providing service only to a chartered accountant. It is not providing service to outsiders. That means professional association is providing service to its own members, and for providing that service, some fees is charged. Now whatever 500 rupees fees along with GST that I have paid to Vijayawada branch of ICAI is there, that is considered as income in the hands of ICAI, and that income is taxable to the ICAI under the head Pgbp. So either trade association or professional association for providing specific services to members, if any fees is received, that fees is taxable to them under the head Pgbp. Next. The following export incentives from government are taxable under the head Pgbp. Profit on sale of import entitlement license, cash assistance against exports. Sometimes government gives cash assistance. If I do 10 crore rupees turnover, 5 lakh rupees cash reward will be given to me. That means what? Like cash reward is directly linked to exports. If you do more exports, you are going to get more cash reward. So if you are getting any cash assistance or cash reward for doing the exports, then whatever the cash assistance or cash reward that is received from government is there, that cash reward is also considered as income, and that income is taxable under the head Pgbp. I did 10 crores exports. For that I received 5 lakh rupees cash assistance from government. This 5 lakh rupees that I have received is considered as income and that is taxable under the head Pgbp. Next, duty drawback. See, you all know, you have studied GST. On inputs we pay GST. But if we prove to the government, in certain cases, whatever the inputs that we have purchased, all of them are exclusively used for the purpose of export, then whatever the GST paid on input is there, that will be refunded by government, that will be given back by government. We call it as duty drawback. I purchased 1 lakh worth of steel to manufacture bottles. On 1 lakh rupees, I paid 18% GST. So how much is GST 1 lakh rupee? On 1 lakh rupees, 18,000 I paid on manufacturing of I paid on purchase of steel. Using this steel, what I did, I manufactured bottles. All these bottles I exported outside India. If I am able to prove to the government and if it is the eligible scheme, then whatever 18,000 rupees that I paid on purchase of raw material is there, that 18,000 rupees will be given back to me, subject to the condition all of this material should be used for the purpose of export. Now I got 18,000 back from the government. This is considered as income and that income is taxable under the head Pgbp. So whatever the export related benefits are there, for those benefits, if it is received by SSC, those are considered as income in the hands of SSC and they are taxable under the head Pgbp. Next, any perquisite that arises during the course of business or profession. I provided one service to the client. Client did not give me cash. Client did not pay me fees. But client gave one mobile to me. Whether client gave mobile to me at free of cost? No. I gave him service. In consideration of that service, he is giving a mobile worth 20,000 rupees to me. Now, I did not get fees or I did not get cash. I received benefit from the client. So whatever the benefit that is received while rendering the services during the course of profession or under the business, whatever the perquisite that is received is there, even that perquisite is also taxable under the head Pgbp. Next, you all know, in case of partnership firm, see, in case of partnership firm, what happens? Partner will receive interest on partner's capital, remuneration. Okay, so whatever the expenses that are there in case of partnership firm to the partner, all those expenses will be considered as income in the hands of partners and that income is not taxable to the partners under the head Pgbp. So in partnership firm, interest on partner's capital is allowed as expenditure. Remuneration is allowed as expenditure subject to some conditions. So whatever the interest, remuneration, bonus, commission that is allowed is there. See, in partnership firm books of accounts, in P&L account, debit side, whatever interest on partner's capital, salary, bonus, commission, all of these are there. All these are considered as income in the hands of partners and such income is taxable to the partners under the head Pgbp. Very simple. In partnership firm, whatever the expenditure that is allowed with regard to partners is there, same amount of expenditure is considered as income in the hands of partners and such income is taxable under the head Pgbp to the partners. Next, profit, share of profit. Whatever the share of profit received by partner from partnership firm is there, such share of profit is not taxable, share of profit is exempt. So I am speaking now from partner point of view. Partner is receiving salary, interest, bonus, commission, remuneration. All these are considered as income in the hands of partners to the extent of expenditure allowed as deduction to partnership firm. If partner receives share of profit from partnership firm, whatever the share of profit that is received, that is considered as income and that income is not taxable, it is fully exempt. Next, non-compete fees. See, if any non-compete fees is received for not giving the competition, then whatever the non-compete fees that is received is there, that is considered as income, and that income is taxable under the head Pgbp. Is it clear? Right now I am doing online teaching. One person approached me and asked me, don't teach in online, I will give you 20 lakh rupees. So I said I won't teach, and I took 20 lakh rupees. Now whatever 20 lakhs that I received right now, that is non-compete fees, and that is taxable to me under the head Pgbp. So with regard to intangible assets, also for not sharing the rights, know-how, trademarks, patents with any other person, if any non-compete fees is received, that non-compete fees is taxable under the head Pgbp. Next, any sum received by employer under keyman insurance policy. See, against important person in the organization, generally keyman insurance policy will be taken. So if any keyman insurance policy is received, then for keyman insurance policy, whatever the compensation that is received is there. Keyman insurance policy, two things are there: premium, compensation. Premium is expenditure, right? That expenditure is allowed as deduction to employer under section 37. For taking keyman insurance policy, if any premium is paid, such premium is allowed as deduction under section 37. If any compensation is received, if compensation is received by employer, to employer, that compensation is taxable under the head Pgbp. If keyman insurance policy compensation is received by employee, for employee, that compensation is taxable under the head income from salaries. If employee died, after death of employee, keyman insurance policy compensation received by family members of employee. For family members of employee, keyman insurance policy compensation is taxable under the head income from other sources. This is simple chart with regard to keyman insurance policy. Whatever the premium expenditure is there, allowed as deduction under section 37. Whatever the compensation is there, received by employer, taxable under Pgbp. If compensation is received by employee, taxable under salaries. If compensation is received by other family members, taxable under other sources. Next, in conversion of inventory into capital asset. See, if any inventory is converted into capital asset, inventory means what? Stock in trade. So if stock in trade is converted into capital asset, on date of conversion, whatever the fair market value is there, that fair market value is considered as income, and that income is taxable under the head Pgbp. I am doing gold business. In that gold business, one bangle, gold bangle worth 40,000 rupees, I took from the business and I brought that bangle to my home and gave it to my mother. That means what? In my business, gold bangle is stock in trade. Now that gold bangle I am taking from my business and carrying it to the home. The moment I brought it to home and gave it to my mother, it is not a stock in trade, it is a capital asset. So whenever I convert stock in trade into capital asset, then the day on which I am converting stock in trade into capital asset, I have to check the fair market value of the stock in trade. So when I brought that gold bangle to my home, fair market value of gold bangle is 40,000 rupees. Now this 40,000 rupees is considered as income in the gold business, and that 40,000 is taxable under the head Pgbp. So on conversion of stock in trade into capital asset, on the date of conversion, whatever the amount is there, fair market value, that fair market value is considered as income, and such income is taxable under the head Pgbp. Any sum received on account of capital asset being demolished, destroyed. See, this you will understand in section 35 AD. Next I am going to discuss. At that time you will get clarity. So this is all about section 28, incomes taxable under the head Pgbp. Just now we finished section 28, right? Section 28 is charging section. Next we are going to discuss about section 30 to section 37. Section 30 to 37, these sections speak about expenses allowed under Pgbp head. So while calculating income under the head Pgbp, whatever the eligible expenses are there, those eligible expenses are allowed as deduction. After claiming expenses as deduction, whatever the balance profit is there, only balance profit is taxable. Sir, what are the expenses that are allowed as deduction? That we are going to discuss in section 30 to 37. Shall we discuss? Yes. First section is section 30. Section 30 speaks about expenses with regard to building. See, building I can use as a owner or I can use the building as a tenant. Just think normally, don't see anything. If I use this building, whatever the building I am using for recording, this building is owned by me. Now with regard to this building, what are all the expenses that I can claim as deduction? Am I using this building for my business purpose? Yes, I am doing recording for my business purpose only. I am using this building. What are all the expenses that I can claim as deduction? On this building, I can claim depreciation. On this building, whatever the repairs and maintenance are there, repairs and maintenance expenses I can claim as deduction. For this building, I took fire insurance. Fire insurance premium, whatever that I have paid, that also I can claim as deduction. For this building, I am paying municipal taxes. Those municipal taxes I can claim as deduction. So all these expenses are allowed as deduction if you are owning the building as owner. What are the expenses? Depreciation, revenue repairs. Revenue repairs means what? Normal repairs. Like the benefit lasts for a shorter period of time. If I do capital repairs, that means what? I demolished this entire room, I reconstructed the new room. That you cannot call as repairs, you should call it as reconstruction. So whatever the minor repairs expenses are there, revenue repairs, those expenses that I can claim as deduction, fire insurance premium, municipal taxes, and whatever the taxes. Let's say I am a businessman and I have business in USA. In USA also I opened one office. Okay. And that office is owned by me. With regard to that office, whatever the municipal taxes that I pay to foreign government are there, even those municipal taxes also I can claim as deduction. Case 2. Now I am not the owner of this building. I took this room, whatever the recording room is there, studio room, I took studio room on rent. Every month rent is, let's say, 25,000 rupees. Now, as a tenant, what are all the expenses that I can claim as deduction? Every month I am paying rent, right? 25,000 I can claim as deduction. Remember one thing, rent and depreciation both are not allowed as deduction simultaneously. Either as a owner you claim depreciation or as a tenant you claim rent as a deduction. Same time you cannot claim both depreciation and rent as deduction. So as a tenant I can claim rent as deduction, fire insurance premium, revenue repairs and municipal taxes. See, owner told me, with regard to the room that you have taken on rent, whatever the municipal taxes are there, even municipal taxes are also to be paid by the tenant. So I have paid municipal taxes. As a tenant, whatever the municipal taxes that I have paid, even those also I can claim as deduction. Next. Let's say there are two rooms. One room I am using for recording. Another room I am using for my family purpose. My family is living in that room. That means what? In total building, part of the building is used for business purpose and part of the building is used for personal purpose. Now, whatever the part of the building that is used for business purpose is there, only on this part I can claim depreciation as deduction. That means what? If an expenditure is incurred partly for official purpose and partly for personal purpose, whatever the proportionate official purpose expenditure is there, only that is only allowed as deduction under the head Pgbp. Another important point. I am a sole proprietor. I own this building. I am claiming depreciation. At the same time, I cannot claim rent as deduction. I should not speak logic now. Let's say I am telling like this. I am the owner of this building. If I do not use this building for recording and if I give this building on rent, I would have get 10,000 rupees. As I am using this building for my for my recording purpose, I lost 10,000 rupees notional rent. This 10,000 rupees is loss for me because of this recording. So I will claim 10,000 rupees as deduction in P&L account. Will it be allowed? It will not be allowed. Income tax officer will disallow it. Notional rent is not allowed as deduction. In case of sole proprietary concern, if he is the owner, he can claim depreciation. He cannot claim notional rent as deduction. However, in case of partnership form, partners are different, partnership form is different. So if partnership form pays any rent to the partner being the owner, then whatever the rent paid is there, that is allowed as deduction to the partnership form. Capital repairs, I told you, right? Let's say whatever the capital repairs, I have done ceiling to this room. I will use this ceiling for next 10 years. Now ceiling is like a capital expenditure. Whatever the capital expenditure is there, that is not allowed as deduction in P&L account in 1 year. It will be recognized as a capital asset and it will be allowed as deduction over a period of time using depreciation rates. Next, section 31, it speaks about expenses of plant, machinery and furniture. I purchased one generator. Now who is the owner of the generator? I am the owner. That means plant and machinery is owned by me. Whatever the depreciation on that generator is there, I can claim it as deduction. Maintenance is there. Every 3 months I will do maintenance for generator. Whatever the maintenance expenses are there, those maintenance expenses also I will claim as deduction. For generator, I took fire insurance premium. I purchased it with 5 lakh rupees. If fire comes and power generator gets caught in the fire, means I will lose 5 lakh rupees. So I took fire insurance premium. That also allowed as deduction. Next, as a tenant. Tenant means what? I took generator on rent. Whatever the rental charges that I am paying on generator is there, that is allowed as deduction. Small minor repairs as a tenant, if I do for that generator, that is also allowed as deduction. If I take fire insurance premium, even though as a tenant, then that is also allowed as deduction. So as a owner, with regard to plant and machinery, owner can claim depreciation, owner can claim revenue repairs and maintenance, owner can claim fire insurance premium paid as deduction in P&L account. Same are also allowed as deduction to tenant also, but in case of tenant, in place of depreciation, rent is allowed as deduction. Insurance and repair charges of assets which are owned by the SSC but have not been used by the SSC during the previous year would not be allowed as deduction. What do you mean by this? I purchased one asset, one plant and machinery, but I am not using that plant and machinery. If I am not using that plant and machinery, then whatever the expenses that are incurred for that plant and machinery are there, they are not allowed as deduction. Only if such plant and machinery is actually used, then only it will be allowed as deduction. This I have told, partly for business purpose, partly for personal purpose. In such case, proportionate expenditure incurred for office purpose is there. Only that proportionate expenditure is allowed as deduction under Pgbp head. Repairs will include renewal or renovation of an asset, but not its replacement or reconstruction. See, if any small parts are renewed, okay, then whatever the repairs expenditure is there, that repairs expenditure we call as revenue repairs expenditure, and that is allowed as deduction in P&L account. If the part is defective and entire plant and machinery is replaced, replacement of plant and machinery cannot be considered as revenue repairs, it is capital repairs and it should be capitalized. So whatever the small renewals or replacements are, small renovations are there, only they are allowed as deduction in P&L account. If there is any replacement or reconstruction of the building, that is not considered as revenue repairs. Capital repairs, I told, capital repairs are also allowed as deduction in P&L account, but not in current year. First you have to recognize it as a asset and you have to provide depreciation for it over a period of time. So these are all the expenses relating to section 30 and section 31. Next, section 32, depreciation is there. I thought depreciation is a very important concept. So I will make a separate video on it, simplifying entire depreciation concept rather than, explaining that concept in the middle. Next, I will start with the section 35, scientific research expenditure. See, if any scientific research expenditure is incurred, there are two types of scientific research expenses: in-house scientific research, contributions or donations. I am a very big company, worth of 1000 crores. Now I can allot some of the funds for scientific research. There is a small company which is doing turnover of 25 lakhs. Now can that company spend for scientific research? No. Then that company will give donation for scientific research. Not only in-house scientific research expenditure, even if any donation is given, such donation given for scientific research is also allowed as deduction under section 35. First, let us discuss about in-house scientific research. Whatever the in-house scientific research is there, that should be related to assessee's business or profession. Then only in-house scientific research expenditure is allowed as deduction. Here, a question comes, sir, whether only current year scientific research expenditure is allowed as deduction, or if any expenditure is incurred before commencement of the business, whether it is allowed as deduction or not. The answer is yes. Not only after commencement of business, even before commencement of business also, if any scientific research expenditure is incurred, such scientific research expenditure is allowed as deduction under section 35. Let's say today on 19th February 2025, a business was started. From this date onwards, last 3 years, whatever the scientific research expenditure that is incurred for this business is there, even that scientific research expenditure is also allowed as deduction in current previous year. Are you able to understand? So expenses incurred during 3 years immediately before the date of commencement of business. Not only revenue expense, both revenue expenditure and capital expenditure will be allowed as deduction in P&L account. See, today I started a business. 1 year ago, like I purchased one building. In that building, I have done research and development. For that, I have incurred certain expenses. I took some staff. They are doing research experiments. For staff, I am paying salaries, and for experiments, I purchased material. That material cost is for research. So whatever the scientific research expenditure that is incurred even before commencement of business, that is also allowed as deduction. Not only revenue expense, both revenue expenditure as well as capital expenditure that is incurred before commencement of business is allowed as deduction in P&L account in the year in which business is commenced. Are you able to understand? Good. After commencement of business, obviously once business is started, the year in which business is started, from that year onwards, every year, whatever the expenditure that is spent for scientific research is there, both revenue expenditure and capital expenditure. Generally, capital expenditure we will recognize as asset and we will provide depreciation every year. But if you are purchasing asset for scientific research purpose, 100% of the asset expenditure, 100% of the capital expenditure you can claim as deduction in P&L account. Are you able to understand? Let's say I purchased a laptop for scientific research, 1 lakh rupees. Total 1 lakh rupees I can claim as deduction in current previous year only. So after commencement of business, whatever the scientific research expenditure is there, both revenue and capital expenditure is allowed as deduction in P&L account. See, after commencement of business, any revenue expenditure is allowed as deduction. But before commencement of business, revenue expenditure means only salaries and material cost. What do you mean by this? I will tell this example. Before starting the business, I took one flat on rent. In that flat, I am doing research. For research, I am purchasing research material and I am also paying salaries to staff. I am also paying the rent. Now, for the purpose of research, I paid 3 expenses: rent, salaries expenditure and material expenditure. Material expenditure is allowed as deduction, salaries expenditure is allowed as deduction, but rent expenditure is not allowed as deduction, because before commencement of business, revenue expense means only salaries expenditure and material expenditure. After commencement of business, okay, after commencement of business, revenue expenses, whatever the expenditure that is incurred for scientific research is there, all revenue expenses you can claim as deduction. Similarly, capital expenditure means any capital expenditure excluding cost of land. If I purchase any land, that amount is capital expenditure, but that is not allowed as deduction in P&L account. The only reason is land is not a depreciable asset. That's why land expenditure is not allowed as deduction. Other than land, if any capital expenditure is incurred, total capital expenditure is allowed as deduction in P&L account. This is all about in-house scientific research. Next, contribution to outsiders. If I give any donation to approved, very important, I gave donation to my brother who is doing scientific research. Is it allowed as deduction? it is not allowed as deduction. Only if I give donation to approved scientific research association or approved university or approved company, approved by government, okay, then only whatever the donation that I give, that donation 100% of such donation is allowed as deduction. Not only for scientific research, even for scientific research or social research or statistical research. For these three purposes, if I give any donation to approved research association or approved university or approved college or approved company, then whatever the donation that I am giving, 100% of the donation is allowed as deduction under section 35 under the head Pgbp. So you can see here payment made to approved research associations, approved university, approved Indian company, IIT, National Laboratory. So whatever the donation given to approved institutions is there, that is allowed as deduction. But this benefit is available only under optional tax rates. If SSE is paying taxes under default tax rates, then whatever the donation that is given, that is not allowed as deduction under the head Pgbp. Only if SSE is paying taxes under optional tax rates, then only donation given is allowed as deduction under section 35. Next, sale of scientific research asset. Sale of scientific research asset. For research and development, I purchased one laptop worth 80,000 rupees. When I purchased it, I purchased in 24-25. So in 24-25, in P&L account, total 80,000 is allowed as deduction in P&L account. The reason is, even though it is capital expenditure, it is spent for scientific research. So total 80,000 is allowed as deduction in P&L account. Well and good. In 25-26, I sold a laptop. I sold a laptop directly from scientific research department. From scientific research department, I sold the laptop. 3 cases. Sold for rupees 80,000, sold for rupees 60,000, sold for rupees 1,30,000. Whenever scientific research expenditure asset is sold directly from scientific research department, then whatever the sale proceeds are there, sale proceeds to the extent of deduction claimed earlier. How much is deduction claimed earlier? 80,000 rupees, right? Here I sold it for same cost, 80,000 rupees. So this total 80,000 rupees is taxable to me under the head Pgbp. Case 2, I sold it for only 60,000. I purchased it for 80,000. I sold it for 60,000. How much I got? I got 60,000 rupees. Whatever the income that is received, that is also taxable under the head Pgbp. Case 3, I sold it for 1,30,000. I purchased it for 80,000. I sold it for 1,30,000. Out of 1,30,000, whatever the amount of deduction that is claimed earlier is there. How much deduction was claimed earlier? 80,000 rupees. Out of 1,30,000, 80,000 is taxable under the head Pgbp. 50,000 is taxable under the head capital gains. Sir, short term or long term? It depends upon period of holding. Based on period of holding, you will classify it as short term or long term. So whenever you are selling the asset from scientific research department directly, outright, then out of total sale proceeds, whatever the amount of deduction claimed earlier is there, to that extent amount is taxable under the head Pgbp. Balance amount is taxable under the head capital gains. That's what I have written. Sold without using for the purpose of business. Then to the extent of deduction claimed earlier, taxable under the head Pgbp. Balance, it is taxable as capital gains. This is case 1. Next, case 2. What is case 2? In case 2, I am not selling the asset. I am using the asset in my another department. Let's say I purchased laptop worth 80,000 rupees in 24-25 for scientific research. Total 80,000 rupees I claimed as deduction in P&L account. Next year, the laptop became outdated. So I shifted laptop from scientific research department to accounts department. So whenever I transfer asset from scientific research department to another department, then it is not used for scientific research, but it is used in the business only. In such a case, whatever the asset that I transferred is there, that will be added to the cost of the, that will be added to the block of assets. Generally, plant and machinery block is there, 40%. So to that plant and machinery block, whatever the laptop I transferred from scientific research department, accounts department is there, that laptop also I will add. Only count number of laptops, number of plant and machinery increases, but value will not increase. The reason is, just think logically, if I keep some value, I have to depreciate that value. If I depreciate it, again I am claiming expenditure. Last year, total 80,000 I claimed as deduction in P&L account. If I add that laptop in block at certain amount, then that amount again gets depreciated. It becomes a loophole. That's why whenever scientific research asset is transferred to normal department, then the scientific research asset will be added to the normal block of assets and it will be added at zero value, only count in the block increases. Next, unabsorbed scientific research expenditure. So whatever the unabsorbed capital scientific research expenditure is there, that is allowed as deduction, just like unabsorbed depreciation. Okay. Now let us discuss section 35 AD, specified businesses. See, there are list of 14 businesses here. For these 14 businesses, these are classified as specified businesses. These specified businesses, there is a specified date. You can see here. So if these specified businesses are started on or after the specified date, then for these specified businesses which have started after specified date, whatever the revenue expenditure and capital expenditure is there, 100% of the expenditure is allowed as deduction under Pgbp head. Just now we have seen scientific research expenditure. Just like scientific research expenditure, whatever the capital expenditure is there, for normal businesses, only for scientific research, whatever the capital expenditure incurred is there, that is allowed as deduction. But for specified businesses, not only for scientific research purpose, for any purpose with regard to specified business, if any capital expenditure is incurred, 100% of the capital expenditure is allowed as deduction under the head Pgbp. Are you able to understand? Another important thing is, not only after commencement of business, before commencement of specified business also, if any capital expenditure is incurred, that capital expenditure is allowed as deduction under the head Pgbp in the year in which business is started. Are you able to understand? So that is the advantage. In scientific research case, only 3 years time limit is there. From date of commencement, last 3 years, whatever the scientific research expenditure is there, that is allowed as deduction. But in case of specified business, 3 years time limit is not applicable. Before commencement of specified business, no 3 years time limit. Before commencement, any time, whatever the revenue expenditure and capital expenditure incurred is there, total of such expenditure is allowed as deduction under the head Pgbp in the year in which business is started. But the only condition is, whatever the capital expenditure that is incurred before commencement is there, that should be capitalized in books of accounts in the first year. Only if such capital expenditure is capitalized, then only deduction is allowed in P&L account. Now let us see those 14 businesses. First one is laying and operating a cross-country natural gas pipeline. So, like those who are engaged in the business of construction of pipes in between two countries, those who are in that business. Why those pipelines are constructed for transportation of natural gas. That business, if it is started on or after 1st April 2007, it is eligible for specified business deduction under section 35AD. In that business, whatever the revenue expenditure and capital expenditure is there, 100% of the expenditure is allowed as deduction. Next, cold chain facilities for specified products. Specified products means what? Agricultural produce, forest produce, sea produce, fishes and fish related products. You know cold chain facilities, right? For transportation of fish or fish related products, or for storage of fish or fish related products, generally cold storages are used. So those who are engaged in that cold chain facilities business are there. If they start their business on or after 1st April 2009, they are eligible for deduction under section 35AD. Those who are engaged in the business of construction of warehouses. Why warehouses are constructed? For storage of agricultural produce. Even that business is also eligible for deduction under section 35AD. Next, those who are engaged in construction of hotels. Those who construct either 2-star hotel or above star category hotel on or after 1st April 2010, they are also eligible for deduction under section 35AD. Next, those who are engaged in construction of hospital. In that hospital, whatever the revenue expenditure and capital expenditure incurred is there, 100% of the expenditure is allowed as deduction. But that hospital should contain minimum 100 patient beds. Only those hospitals which are having 100 patient beds and constructed and started on or after 1st April 2010, they are eligible for deduction under section 35AD. If they choose 35AD, then 100% of the expenditure is allowed as deduction, irrespective of whether it is revenue expenditure or capital expenditure. Next, notified scheme for slum redevelopment or rehabilitation house projects. So those SSCs who are engaged in construction projects, they do only exclusively government related construction contracts under a scheme. What is that scheme? Slum redevelopment or rehabilitation. So under government schemes with regard to slum redevelopment or rehabilitation of rehabilitation housing projects, if any construction business is there, that construction business is also eligible for deduction under section 35AD. Next, notified scheme for affordable housing projects. Those businesses which are doing construction taken under the scheme of affordable housing. Okay, even those businesses are also eligible for deduction under section 35AD. Next, those who are engaged in production of fertilizer. Nagarjuna Fertilizers Limited is there. Okay, what it do? It is in the business of production of fertilizers. So those who are engaged in fertilizer production business, if they start business on or after 1st April 2011, they are also eligible for deduction under section 35AD. Next, those who are engaged in inland container depot and container freight station. That means what? They will set up and they will also operate inland container depot and container freight station. So in that business, if that business is started on or after 1st April 2012, then that inland container depot or container freight station business is there, that business is also eligible for deduction under section 35AD. What is the advantage? If it is classified as specified business, then whatever the expenditure that is incurred is there, both revenue and capital expenditure is allowed as deduction. Next, those who are engaged in beekeeping and production of honey. See how honey is prepared, honey through honeybees, honey is extracted. So those who are engaged in beekeeping business or production of honey business, if they start their business on or after 1st April 2012, they are eligible for deduction. Next, setting up and operating a warehousing facility for storage of sugar. See here, for storage of agricultural produce. Sugar is not an agricultural produce. Sugarcane is an agricultural produce. But sugar, even though it is not an agricultural produce, special recognition is given. So those who are engaged in construction of warehouses, why those warehouses are constructed? For the purpose of storage of sugar. Even for, see, if it is for agricultural produce, under second point, it is classified as specified business. Sugar, even though it is not an agricultural produce, under point 11, if any warehousing facility is started for storage of sugar, that business is also eligible for deduction under section 35AD. Laying and operating a slurry pipeline for transportation of iron ore. So those who are engaged in the business of laying of pipelines. Why? For transportation of iron ore. Even those businesses, if they start on or after 1st April 2012, they will be classified as specified business and are eligible for deduction under section 35 AD. Semiconductor wafer manufacturing unit. See, in technology gadgets, semiconductors will be used. Okay, so those who are engaged in manufacture of semiconductor wafers, even they are also eligible for deduction under section 35 AD. Those who are engaged in the business of developing, operating and maintaining any infrastructure facility. Sir, what do you mean by infrastructure facility? Here it was given. Infrastructure facility means what? Those who are engaged in the business of construction of roads, bridges, rail systems, including toll road, and those who are engaged in the business of construction of highways, those who are engaged in the business of construction of water supply projects, ports, airports, inland waterways. So simply, those who are engaged in construction of these properties are there. Okay, these infrastructure facilities are there. Even these businesses are also classified as specified business, and if these businesses are started on or after 1st April 2017, they are eligible for deduction under section 35 AD. GMR is there. It is into the business of construction of airports. It is into infrastructure development business. Okay, it constructs airports, highways and all. So if it is started on or after 1st April 2017, it will be classified as specified business, and in that specified business 100% of the expenditure is allowed as deduction, irrespective of whether it is revenue expenditure or capital expenditure. You can see before commencement of business, whatever the expenditure that is incurred is there, 100% of the expenditure is allowed as deduction. Business will be allowed as deduction in the previous year in which operations are commenced. So before commencement of business, whatever the expenditure is there, revenue expenditure and capital expenditure, total expenditure is allowed as deduction in the year in which business is started. But the only condition, provided amount is capitalized in books of accounts on the date of commencement. See, generally capital expenditure should be capitalized, right? So before commencement, whatever the capital expenditure is there, that should be capitalized in the year in which business is started. Whatever the capitalized expenditure is there, 100% of the expenditure, even though incurred before commencement, still allowed as deduction. When allowed as deduction? In the year in which business is commenced. After commencement, this you already know, once business starts, specified business, after specified date, then after commencement of business, 100% of the expenditure is allowed as deduction. Another point, if SSE is paying taxes under section 115 BA series, okay, 115 BAA, BAB, BAC, BAD, BAE. So under these sections, if SSE is paying taxes, deduction under section 35 AD is not available. Another thing, deduction under section 35 AD is not mandatory. I started hotel in 23-24. That means after 1st April 2010, I started the hotel 4-star category. It is a specified business. I don't want to claim deduction under section 35 AD. I need not claim. Deduction under section 35 AD is not mandatory. It is at the option of the SSE. If SSE wants to claim deduction, he can claim. If he doesn't want to claim, he need not claim. Next, any loss from specified business can be set off only against specified business profits. What do you mean by this? Specified business loss. If you want to set off against non-specified business profits, can you set off? You cannot set off. Specified business loss can be set off only against specified business profits. Can you set off? Yes, you can set off. That means what? Specified business loss can be set off only against specified business profits. But specified business loss cannot be set off against non-specified business profits. I will tell another example. Let's say hotel is there. Swarna hotel name is. This was in 2005 constructed. Is it a specified business or not? It is a specified business. But 35 AD deduction is not available. It is a specified business, but 35 AD deduction is not available. Why? Because it was constructed, it was started before 1st April 2010. What I said, hotel of 2-star or above category on or after 1st April 2010. So after 1st April 2010 only, if new hotel is started, 35 deduction is available. If before it is started, 35 deduction is not available. So Swarna Hotel started in 2005. Is it a specified business? Yes, it is a specified business. But is it eligible for 35 deduction? No, it is not eligible. Are you able to understand the difference? Sometimes, even though it is a specified business, if it is started before specified date, it is not eligible for deduction under section 35 AD. Is it clear? So specified business loss can be set off only against specified business profits. Specified business loss cannot be set off against non-specified business profits. Quite often I am saying 100% of the expenditure is allowed as deduction. But if you are making a payment worth more than 10,000 rupees to a single person in a single day, you should make such payment by way of bank transaction. For a single person in a single day, more than 10,000 rupees, if you make a cash payment, then that expenditure is not allowed as deduction. So generally for specified business, both revenue expenditure and capital expenditure is allowed as deduction. But if you are making payment of more than 10,000 rupees to a single person in a single day, you should make payment by way of bank transaction. If you are making cash payment, it is not allowed as deduction. Only bank payment is allowed as deduction. Next, there are some conditions. If you want to claim deduction under section 35 AD, there are some conditions. Conditions for claiming deduction under section 35 AD. First condition, the specified business should not be set up by splitting up, reconstruction of a business already in existence. See, in 2010, new rule came. After 2010, if any new hotel starts eligible for deduction under section 35 AD. So what I have done, I purchased an old hotel, I changed paintings and I renamed it and I want to claim deduction under section 35 AD. Can I claim? No. Whatever the building or plant and machinery that is there, if the old plant and machinery and building that I am using, that means old business I am purchasing and naming it as a new business, that is not eligible for deduction under section 35 AD. If you want to claim deduction under section 35 AD for specified business, like it should be a new business, it should not be set up by way of splitting up. Let's say demerger happened, okay, one entity came out, that entity is not eligible for deduction under section 35 AD. Are you able to understand? Only after specified date, if a new business is started, then new specified business is started, then only it is eligible for deduction under section 35 AD. Already existing business by way of amalgamation or demerger, if any new business is found, that is not eligible for deduction. Next, specified business should not be set up by transfer of old plant and machinery. What do you mean by this? I constructed a new hotel. When I constructed in 24-25. In new hotel, I want furniture, I also want air conditioners. Out of total plant and machinery and furniture, first the rule is 100% of the plant and machinery and furniture should be first hand. But there is exception. What is exception? 20% of plant and machinery can be second hand. I have set up a specified business on or after the specified date. I wanted to claim deduction under section 35 AD. Can I claim? Yes. The rule is whatever the plant and machinery is there, it should be a first hand plant and machinery. But small relaxation is there. What is the relaxation? In the new specified business, 20% of the plant and machinery or furniture I can purchase from second hand. If more than 20% of plant and machinery and furniture is second hand, then I cannot claim deduction under section 35 AD. So if I want to claim deduction under section 35 AD, maximum I can purchase only 20% of plant and machinery and furniture as second hand. If more than 20% I purchase as second hand plant and machinery, then I am not eligible to claim deduction under section 35 AD. Here another relaxation was also given. First relaxation is out of total plant and machinery, 20% of plant and machinery can be second hand. Second relaxation, if I import any machinery from outside India, even though it is second hand, but in India it will be deemed as first hand plant and machinery. Are you able to understand? I started a studio. I thought one video recorder is very much useful for me and it is not available in India, it is available in USA. I imported that from USA. I did not purchase. My friend is already using that video recorder in USA. I purchased that video recorder and I brought it here. Now this is second hand actually. But for the purpose of specified business, if any asset is imported from outside India, even though it is second hand plant and machinery, it will be deemed as first hand plant and machinery only. Are you able to understand? That is second relaxation. First relaxation is 20% of plant and machinery can be second hand plant and machinery. Second relaxation is any asset imported from outside India, even though it is already used there, even though it is second hand, for this class we will deem it as first hand plant and machinery. Are you able to understand? The only condition is in India on imported plant and machinery, no person should claim depreciation. You are the first person should be claiming depreciation. Then it will be deemed as first hand plant and machinery. So whatever the asset that is imported from outside India is there, even though I am purchasing second hand, still it will be deemed as first hand plant and machinery provided no depreciation is claimed on that plant and machinery in India. Is it clear? Good. You can see imported plant and machinery will be deemed as new plant and machinery when if it is not used in India previously, imported to India from any country outside India, no depreciation has been claimed. Is it clear? If these conditions are satisfied, even though you are importing second hand plant and machinery, it will be deemed as first hand plant and machinery provided no depreciation should be claimed on it previously in India. Once you claim deduction under section 35 AD, no deduction will be allowed under other sections. Whatever the expenditure that is allowed as deduction under section 35 AD, such expenditure is not allowed as deduction under any other section in Income Tax Act. Next, let's say I started 5-star hotel with the name Novotel, but that hotel is running into losses. What I did not sell my hotel. Right now I am managing the hotel, but management of this hotel I gave to another hotel called Minerva. Now Minerva will come and it will manage my Novotel hotel. Just because management is transferred, you cannot say I cannot claim deduction under section 35 AD. Just because management is transferred, even though management of the hotel is transferred, still I am eligible to claim deduction under section 35 AD. So in case of hotel business, even though management is transferred, still the owner is eligible to claim deduction under section 35 AD. Next, this point. This point you will not understand without example, so I will teach one example. In 24-25, I started hotel, right? 5-star. In this hotel, I purchased one air conditioner. Whatever the asset purchased in specified business is there, that should be used for 8 years. Before 8 years, I sold this AC. Then whatever the sale amount received is there, that is taxable under the head Pgbp. Is it clear? Very simple. Whatever the asset purchased for specified business is there, to claim deduction under section 35 AD, it should be used only for specified business for minimum 8 years. Before 8 years, if it is demolished, if it is not used and such asset is demolished, destroyed or discarded, then sum received. What is sum received? Nothing but sale proceeds. On sale of that asset, whatever the sale proceeds are there, those sale proceeds are taxable under the head Pgbp. I have two businesses. One is hotel business, another one is coaching business. Now what I have done, before 8 years, I have transferred AC from hotel business to coaching business. Hotel business is specified business. I claim a deduction under section 35 AD. Now I have to use that air conditioner for minimum 8 years. Before 8 years only, I shifted air conditioner from specified business to non-specified business. I shifted air conditioner from hotel to coaching business. Before 8 years, if I do such transfer, then whatever the 100% deduction that I claimed in specified business is there, that will be reversed. That means what? 100% of the expenditure I claimed as deduction is there, that will be considered as income and it is taxable under the head Pgbp. Are you able to understand? One small business, let's say AC value is 40,000 rupees. In 24-25, in hotel business, I claim a total 40,000 as deduction. I claim total 40,000 as deduction. In 25-26, what I have done, I have transferred this AC from hotel business to coaching business. Now, whatever the deduction that is allowed is there. Total 40,000 rupees is considered as income. And whatever the depreciation that would have been allowed if asset is not used for specified business, if air conditioner is not used for hotel business, whatever the depreciation that would have been allowed, that will be allowed as deduction. If air conditioner is used for coaching business from the beginning, then 15% depreciation would have been allowed, right? That will be allowed as deduction. 40,000 into 15%, 6,000 is allowed as deduction. So simple. Specified business asset sold before 8 years. Whatever the sole proceeds are there, considered as income. Before 8 years, it is shifted to non-specified business. Then 100% deduction claimed earlier will be recognized as income. And whatever the accumulated depreciation that would have been allowed if asset is not used for specified business, that accumulated depreciation is allowed as deduction. Is it clear? Good. Section 35D, preliminary expenses. See, deduction for preliminary expenses is allowed only for residents. In case of company, preliminary expenditure deduction is allowed only for Indian company. For foreign companies, preliminary expenditure is not allowed as deduction. In case of other category of persons, only if they are resident in India. For resident non-corporate SSC, that means only for residents, preliminary expenditure is allowed as deduction. For non-residents, preliminary expenditure is not allowed as deduction. So deduction for preliminary expenses allowed as deduction for either Indian companies or resident non-corporate SSCs, only for residents. Sir, what preliminary expenditure means? See, before starting the business, for preparation of feasibility report, project report, market survey, conducting market survey, and in case of company, for preparation of MOA, AOA, and for printing of MOA and AOA, and whatever the legal charges for incorporation are there, all these expenses we call as preliminary expenses. Preliminary expenses, these are not allowed as deduction in the year of commencement at one go. That means in a single transaction, preliminary expenses are not allowed as deduction. Generally, preliminary expenses are allowed as deduction over a period of 5 years in 5 equal installments starting from the year in which business is commenced. That means from the year in which business is commenced, from that year onwards, over a period of 5 years, you can claim preliminary expenses as deduction in 5 equal installments. Another important point, not only for new businesses, even in case of existing businesses also, for setting up of a new unit or for setting up of a new undertaking, if any expenditure is incurred, even that expenditure is also considered as preliminary expenditure. That means not only for new companies or new businesses, even for existing businesses also, preliminary expenditure is allowed as deduction when in case of existing businesses, for extension of new unit or for establishment of new branch or for establishment of new undertaking, if any expenditure is incurred, that expenditure we call as preliminary expenditure. Is it clear? Let's say there is a company, it is operating in Andhra Pradesh and Telangana. Now that company wants to start operations in Tamil Nadu also. So before starting operations in Tamil Nadu, whatever the expenses incurred for setting up of operations in Tamil Nadu are there, that are also considered as preliminary expenditure, and that is also allowed as deduction. Whole point of discussion is just to convey with you, not only for new companies, even for existing companies also preliminary expenditure is allowed as deduction if they are going for any extension. Is it clear? Sir, how much preliminary expenditure is allowed as deduction? 100% of the preliminary expenditure is not allowed as deduction. In case of resident non-corporate SSC, 5% of cost of project or actual preliminary expenses, whichever is lower is there, only that amount is eligible. Whatever the eligible preliminary expenditure is there, eligible preliminary expenditure is allowed as deduction over a period of 5 years in 5 equal installments. Is it clear? So let's say I am a sole proprietor. Am I a company? I am not company. I wanted to start one project. Cost of project is 100 crores. For that project, I prepared a project report, MOA, sorry, it's not a company, right? I prepared project report, feasibility report. I have conducted market survey. For doing all this, it costed me 8 crores. So how much is preliminary expenditure? 8 crores. Whether total 8 crores is allowed as deduction, let us see. How much is eligible preliminary expense? Eligible preliminary expenditure is equal to 5% of cost of project or actual preliminary expenses, whichever is lower. 5% of cost of project means 5 crores or 8 crores, whichever is lower means only 5 crores is allowed as deduction. Is it clear? This 5 crores is allowed as deduction over a period of 5 years in 5 equal installments. That means what? Every year 1 crore is allowed as deduction for a period of 5 years. So actual preliminary expenses, they are not allowed as deduction. Eligible preliminary expenses are allowed as deduction over a period of 5 years in 5 equal installments. In case of Indian company, how to calculate eligible preliminary expenses? Eligible preliminary expenses will be calculated in 3 steps. Step 1, 5% of cost of project or 5% of capital employed, whichever is higher. Step 2, actual preliminary expenses. Step 3, eligible preliminary expenses is equal to step 1 or step 2, whichever is lower. I will tell one example. Indian company is there. Cost of project is 80 crores. Capital employed is 50 crores. It incurred preliminary expense of 6 crores. How much is preliminary expenditure? 6 crores. Now, what we need to calculate? We need to calculate eligible preliminary expense. That will be calculated in how many steps? 3 steps, right? Step 1, 5% of cost of project or 5% of capital employed, whichever is higher, correct? How much is cost of project? 80 crores. 80 into 5%, 4 crores, or 50 into 5%, 2.5 crores. Whichever is higher means 4 crores. Step 2, actual preliminary expenditure. How much? 6 crores. Step 3, eligible preliminary expenditure is equal to 4 crore or 6 crore, whichever is lower. That means 4 crores is allowed as deduction. And this 4 crores is allowed as deduction over a period of 5 years in 5 equal installments. That means 4 crores into 1 by 5. Every year 80 lakhs will be allowed as deduction. Are you able to understand what cost of project means and what capital employed means? I have given definitions here, you can go through. 35 DDA, amortization of VRS expenditure. In salaries, we discussed about VRS compensation. That is from employee point of view. If employee receives VRS compensation, it is taxable to the employee under the head salaries. Simultaneously, exemption is also allowed. From employer point of view, if employer is paying VRS compensation to the employee, VRS compensation is allowed as expenditure. Now, total VRS compensation is not allowed as expenditure in a single go. VRS compensation expenditure is allowed as deduction over a period of 5 years in 5 equal installments, starting from the year in which VRS compensation was actually paid. That means what? VRS compensation expenditure is allowed as deduction on payment basis. Whenever VRS compensation is paid, from that year onwards, VRS compensation is allowed as deduction over a period of 5 years in 5 equal installments. Let's say 40 lakhs VRS compensation is paid by employer. Total 40 lakhs he cannot claim as deduction in P&L account. Total 40 lakhs is not allowed. 40 lakhs into 1 by 5. That means how much? 8 lakhs is allowed as deduction in first year. Second year 8 lakhs. Likewise, over a period of 5 years, in 5 equal installments, VRS compensation expenditure is allowed as deduction. Now, students will get doubt. Sir, VRS compensation is 40 lakhs, but it is not paid in single installment. First year, 20 lakhs paid. Second year, 15 lakhs paid. Third year, 5 lakhs paid. That means 24, 25, 20 lakhs was paid. 25, 26, 15 lakhs was paid. 26, 27, 5 lakhs was paid. Now, what is the treatment, sir? This 20 lakhs is allowed as deduction over 5 years, starting from 24, 25. This 15 lakhs is allowed as deduction over a period of 5 years, starting from 25, 26. This 5 lakhs is allowed as deduction over a period of 5 years, starting from 26, 27. So, whenever compensation is paid in installments, each installment is allowed as deduction over a period of 5 years in 5 equal installments. Is it clear? Very simple. VRS compensation expenditure allowed as deduction on cash basis. Whenever it is paid, then only it is allowed as deduction. If compensation is paid in installments, each installment is separately allowed as deduction over a period of 5 years in 5 equal installments, starting from the previous year in which such installment was paid. Next, in case of conversions means what? When a sole proprietary concern is converted into company, or when a partnership firm or LLP is converted into company, or company is converted into LLP, in case of conversion, when predecessor paid VRS compensation, predecessor is eligible to claim deduction. But after payment of VRS compensation, if conversion happens, then for balance period, successor is eligible to claim VRS compensation expenditure. Sole proprietorship paid VRS compensation. Sole proprietorship is eligible for deduction, VRS compensation deduction for 5 years. After 2 years, sole proprietorship is converted into company. Now for balance 3 years, company can claim balance VRS compensation expenditure as deduction. Is it clear? Now let us start discussing deductions under section 36. First, 36(1). Insurance premium is allowed as deduction under section 36 clause 1. Whenever you take insurance for the purpose of stocks and stores, that means against risk of damage of stocks and stores, if you pay any insurance premium, such insurance premium is allowed as expenditure under section 36 clause 1. Similarly, if employer pays health insurance premium on the life of employees, when I used to work in Infosys, 5 lakh rupees health cover is there. That means if something happens to me, 5 lakh rupees medical expenses are paid by Infosys. Do you really think Infosys pays? No, Infosys will pay health insurance premium on my name. That means on the name of employee, if any health insurance premium is paid by employer, such health insurance premium is allowed as expenditure. Subject to the condition, health insurance policy should be approved by IRDA. Then for approved medical policy, if any insurance premium is paid by employer, such medical insurance premium is allowed as deduction. Similarly, if any cooperative society pays insurance against life of animals, see, insurance premium paid by Federal Milk Cooperative Society on the lives of cattle. So, cooperative society is paying medical insurance premium against life of animals. but those animals are owned by members of cooperative society. Even though animals are owned by members of cooperative society, still whatever the insurance premium paid by cooperative society on the life of animals is there, that is allowed as expenditure. 36(1) clause 2. See, bonus commission. Whatever the bonus commission paid to employees is there, bonus or commission paid to employees is allowed as deduction under section 36 clause 2. But bonus or commission is allowed as deduction subject to section 43B. We are going to discuss 43B. As per 43B, bonus or commission is allowed as deduction on payment basis. Is it clear? Next. Section 36(1) clause 3, interest on borrowed capital. Whenever I borrow money for the purpose of business and on borrowed money if I pay any interest, such interest expenditure is allowed as deduction under the head Pgbp. For my personal purpose I borrowed money. On that borrowed money I paid interest. That interest is not allowed as expenditure under Pgbp head. That means if you want to claim interest as deduction, borrowing should be related to the business or profession. Then only interest expenditure is allowed as deduction. Next, only revenue nature of interest is allowed as deduction. What do you mean by this? I took 10 lakhs loan. Why I took 10 lakhs loan? For purchasing plant and machinery. When I took loan on 1st April 24. Even though I took loan on 1st April 24, I paid money. It took 2 months for the machinery to come to my factory, and I have done trial run, everything, and I used that machinery. I started using that machinery, put to use. Machinery was put to use on 1st July 24 onwards. So whatever the interest amount is there from date of borrowing up to the date asset was first put to use, whatever this interest is there, this is capital nature of interest. This interest will be added to cost of asset and it will not be debited to P&L account. From put to use onwards, whatever the interest is there, that interest will be debited to P&L account. That means from date of borrowing up to the date when asset was put to use, whatever the interest expenditure is there, that is not allowed as deduction in P&L account. That expenditure will be added to the cost of the asset. After asset is put to use, whatever the interest is there, such interest will be debited to P&L account. So interest is allowed as deduction subject to following conditions. SSC must have borrowed money. Borrowed money should be used for business or profession, then only interest is allowed as deduction. For personal purpose, if any interest is paid, not allowed as deduction. Next, he should have borrowed money. What do you mean by this? In case of sole proprietary business, investment is 80 lakhs. I kept 80 lakh rupees. This is my personal money invested in business. On this 80 lakhs, from my business, I paid interest to myself. That is not allowed as deduction. Only if money is borrowed from outside and interest is paid, then only it is allowed as business expenditure. In case of sole proprietary concern, interest paid to owner himself, okay, that is notional interest, that is not allowed as deduction. Interest is paid or payable on such borrowing. Only if interest is paid, then only interest is allowed as deduction. Like my best friend is there, I asked 10 lakhs loan, he gave 10 lakhs loan, but I did not pay any interest to him. If I do not pay any interest, I am not eligible to claim expenditure. Only if interest is paid for business purpose, only if interest is paid, then only interest is allowed as expenditure. So sole proprietary concern, interest on owner's capital, not allowed as deduction. However, in case of partnership firm, if partnership firm takes loan from partner, whatever the interest that is paid to partner is there, such interest paid by partnership firm to partner is allowed as deduction, but subject to section 40B. There are some conditions in 40B. If those conditions are satisfied, interest paid by partnership firm to partner is allowed as deduction. See, once I borrow money for the purpose of business, sufficient, interest is allowed as deduction. I borrowed money for my business. It is irrelevant For which purpose I borrowed money? Whether I can borrow money for working capital, or I can borrow money for capital asset, or I can borrow money for payment of salaries, I can borrow money for purchase of material. See, you have to prove borrowed money is used for business. For which purpose it is used, that is not relevant. Whether you are borrowing for any purpose, if that purpose is related to the business, then interest on borrowed money is allowed as deduction. Sometimes during Corona, interest rates are very high. If you are genuinely paying higher rate of interest, still that is also allowed as deduction. Whenever you are making interest payment to bank or financial institutions, scheduled banks or financial institutions, then interest is allowed as expenditure as per provisions of 43B. That means only when you pay interest, then only it is allowed as deduction. I am following accrual basis of accounting. I borrowed loan from SBI, scheduled bank. I did not pay interest, but I am following accrual basis of accounting. Can I claim it as deduction? I cannot claim it as deduction. Even the SSC is following accrual basis of accounting. Interest payment to scheduled banks is allowed as deduction only on payment basis as per 43B. Next, zero coupon bonds. Whenever I take zero coupon bonds, see, you all know zero coupon bonds are always issued at a discount and are redeemed at par. Zero coupon bonds are there. Life of zero coupon bonds, let's say 3 years. How much is life of zero coupon bonds? 3 years. I purchased for 60 rupees. 60 rupees. At the time face value, that means what? After 3 years, how much I will get? 100 rupees. So whatever the difference between purchase value and face value is there, this we call as discount. How much is discount? This discount is 40 rupees. This 40 rupees is expenditure to issuer and income to purchaser. That income to purchaser is taxable under the head capital gains. Expenditure is allowed as deduction under the head Pgbp. For issuer, expenditure is allowed as deduction under the head Pgbp. But whatever the deduction that is allowed under Pgbp is there, it is allowed on pro rata basis. That means proportionately. For example, zero coupon bonds are issued on 1st October 2024. So 3 years, 1st October 25, 1st October 26, 1st October 27. That means 30th September 27. So over a period of how many months? 36 months. So in 24-25, how many months are there? October, November, December, Jan, Feb, March, 6 months. Only 6 months expenditure is allowed as deduction. In 25-26, total 12 months. In 26-27, total 12 months. In 27-28, only 6 months, April to September. This is how expenditure is allowed as deduction. Let's say 40 rupees, right? 40 rupees. Let's say 1000 zero coupon bonds are issued. 40 into 1000, how much? 40,000. Total how many months? 36 months. So per month how much? 40,000 divided by 36. Per month 1111 rupees. So for 6 months how much? 1111 into 6. 6,666 is allowed as deduction. Is it clear? See, these are issued in 24-25, but total 12 months you cannot claim as expenditure as they are issued on 1st October. In 24-25, those zero coupon bonds are alive for only 6 months. So for proportionately for 6 months, whatever the discount expenditure is there, only that is only allowed as deduction. Is it clear? Now let us discuss about tax treatment for employer contribution to recognized provident fund and employee contribution to recognized provident fund. Let's say employer paid 1 lakh rupees salary to employee. How much is salary? 1 lakh rupees. Now from this salary, employee contributes 12% to recognized provident fund. Am I correct? Along with employer contribution, employer additionally contributes 12% to recognized provident fund. Correct? So, whatever employer additional contribution 12% to recognized provident fund is there, it is expenditure to employer. And this expenditure to employer is allowed as deduction as per 43B. Allowed as deduction subject to 43B. See, total expenditure to employer is 1 lakh rupees plus 12,000. Expenditure to employer is 1 lakh 12,000. Out of 1 lakh 12,000, 12,000 rupees employer is contributing to the employee recognized provident fund account. So whatever employer contribution to recognized provident fund account 12% is there, that is allowed as expenditure to the employer subject to provisions of 43B. It is also expenditure to employer, allowed as deduction to the employer, but subject to conditions specified under section 43B. So that is tax treatment for employer contribution. So what is tax treatment for employer contribution to recognized provident fund? Employer contribution is allowed as deduction up to the amount permitted by RPF Act. How much is permitted? 12%. So employer contribution to recognized provident fund is expenditure to employer and is also allowed as deduction to the employer subject to the fulfillment of conditions specified under section 43B. Next, whatever this employee contribution is there, for name's sake it is employee contribution. Whether every employee pays to recognized provident fund? No. If every employee has to pay to recognized provident fund, then EPF has to give notice to every employee to deposit 12% to recognized provident fund. Otherwise, employees will take money, they will eat biryani, they will spend off the expenditure. They will not deposit money in recognized provident fund. So what recognized provident fund said? Whatever the amount that employer is giving 1 lakh rupees, from this 1 lakh rupees, what employer will do? Employer pays only 88,000 rupees. Balance 12,000 rupees will be kept with the employer. But whether this 12,000 rupees belongs to the employer, this 12,000 rupees do not belong to the employer. This 12,000 rupees will be considered as employee contribution lying with employer. That 12,000 rupees is employee contribution lying with employer. Tell me one thing, this 12,000 rupees, whether this amount of 12,000 rupees is employer's money? No, it is not employer's money. Employer has to give 1 lakh rupees to employee. Employee money of 12,000 is not given by the employer and is retained with the employer. Why employer is retaining 12,000 rupees? Employer is retaining 12,000 rupees because as per Provident Fund Act, employer has to retain employee contribution, and whatever the employee contribution 12,000 rupees that is retained by employer is there, that employer has to deposit to the recognized Provident Fund account. That means whatever the employee contribution 12,000 rupees is there, that lies with the employer. But who is the owner of employee contribution? Owner of employee contribution is employee, but employer as a custodian, as an agent, employer is holding 12,000 rupees of employee money, and whenever recognized Provident Fund due date comes, employer will pay employee obligation to recognized Provident Fund account. That means 12,000 rupees employee contribution belongs to employee only, but employer is holding that money on behalf of employee, and employer is taking the responsibility to deposit this 12,000 rupees to recognize the Provident Fund account on or before the due date. Correct? As you are only saying this 12,000 rupees does not belong to the employee, so in employer books of accounts, in P&L account, whenever 12,000 rupees or 12% is retained by employer, first this amount will be first recognized as income. Whatever the employee contribution is there, employee contribution will be recognized as income in employer books of accounts. That is step 1. Step 2. there is due date, right? Due date for payment of provident fund amount. Generally, what is the due date? Due date is 15th of next month. So whatever the PF that is deducted in current month is there, that should be deposited to PF account on or before 15th of next month. Case 1. Employer deposited employee contribution of 12,000 rupees before 15th of next month. Deposited before 15th. Let's say this is case A. Employer deposited before 15th of next month. So if employer deposits, then employee contribution is allowed as expenditure. So credit as well as debit, nullify, no effect at all. Employer as an agent took 12,000 rupees from employee, deposited in RPF account. So in employer books of accounts, income is recognized, expenditure is also recognized, nullified. Case B. Deposited after 15th of next month. Deposited after 15th of next month. In case 2, employee contribution is not allowed as expenditure. Employee contribution is not allowed as expenditure. That means what? In case 1, employer has the responsibility. Employer fulfilled the responsibility. As employer fulfilled the responsibility, income is 12,000, expenditure is also 12,000. So there is no effect to the employer. So employer liability is 0. In second case, employer took money from employee, he misutilized the amount. How I am saying he misutilized the amount? Because he did not pay this 12,000 rupees to RPF account before 15th of next month. He paid after 15th of next month. In this case, employee contribution will be recognized as income 12,000 rupees, but employer contribution is not allowed as, employee contribution is not allowed as expenditure. In this case, employer income increases by 12,000. Whenever employer income increases, when income increases, tax also increases. See, employer paid 12,000 rupees after 15th of next month. But as per provisions of Income Tax Act, if it is paid after due date of PF account, it is not allowed as expenditure. If it is not allowed as expenditure, income will remain like that only. Expenditure is not allowed. So transaction is not getting nullified. Employer income is increasing by 12,000. Whenever employer income increases 12,000, tax also increases. For one employee, 12,000. For thousands of employees, income increase will be in crores of rupees. So employer, he will be very much careful and he will deposit the employee money on or before the due date of PF account so that his income will not increase. So why the rule is like this? The rule is like this because the employer should not misutilize the money of the employee. That's why the rule is very strict. Only if employer deposits employee contribution to provident fund account on or before 15th of next month, then only for employer expenditure is allowed as deduction. If employer deposits after 15th of next month, income will be there but expenditure is not allowed. So automatically income increases, employer is required to pay higher tax. So as employer is required to pay higher tax, he will get scared and he will ensure amount is deposited on or before 15th of next month. Are you able to understand? So this is the rule. Employer contribution to recognized provident fund allowed as deduction subject to 43B. Employee contribution, employee is not paying. Employee contribution is also paid by employer. So whatever the employee contribution is there, whenever employer takes that amount, first he will recognize it as income in his P&L account, and this amount, the same amount is allowed as expenditure to nullify the effect. But expenditure is allowed only if PF amount is deposited on or before the due date. If PF amount is deposited after the due date, expenditure is not allowed. Thereby income of employer increases and is required to pay higher taxes. So what is tax treatment for employee contribution? Tax treatment of employee contribution. Firstly, employee contribution received from employee is recognized as income in the books of the employer. This is first step. After recognizing it as income, Then second step, if employer pays employee contribution to PF authorities on or before the due date, then only employee contribution is allowed as expenditure. Otherwise, employee contribution is disallowed. Are you able to understand? I hope I have given good clarity on this concept. Whenever animals are used in the business otherwise than stock in trade, then how to recognize that expenditure? That is the question. For example, event management company is there. It will purchase horses so that it uses horse cart to carry a bride and bridegroom. So for event management company, whatever the horses are there, those horses are not stock in trade. Let's say it has spent 20 lakh rupees to purchase 2 horses. How to recognize that 20 lakh rupees expenditure? That is the question. So whenever an animal is used in a business otherwise than stock in trade, first of all, expenditure is not recognized initially. Whenever animal dies or whenever animal becomes permanently useless, then only we will recognize the expenditure. Today I purchased horses for 20 lakhs. I will not recognize this expenditure. After 5 years, let's say both the horses died. I sold horse bodies and I got 40,000 rupees. Now, in the year of death, I will recognize the expenditure. How much is the expenditure? 20 lakhs minus 40,000. How much? 19 lakh 60,000, correct? 19.6 lakhs will be my expenditure and that will be recognized in P&L account. So in case of animals, in the year of death or in the year they becomes permanently useless, then we will recognize the expenditure. Amount of expenditure allowed as deduction is equal to actual cost minus amount realized on sale of on sale of dead body of animal or on sale of animal. Next, bad debts. See, bad debts are allowed as deduction, but there are some conditions. Only business related bad debts are allowed as deduction. Personal nature of bad debts are not allowed as deduction. I gave 20,000 rupees to my friend. He is not giving that 20,000 rupees to me. This is personal nature of bad debt. That is not allowed as expenditure in P&L account. Next, only revenue nature of bad debts are allowed as deduction. Capital nature of bad debts are not allowed as deduction. What do you mean by this? I sold one plant and machinery. With regard to that plant and machinery, there are bad debts. Those bad debts are not allowed as deduction. Only if and only if income is already recognized and if that income is not realized, then only bad debt is allowed as expenditure. I have done credit sales. I will write the entry debtor account debit to sales. That means in my P&L account I have recognized the sales. But I have sold goods worth 1 lakh rupees. He paid 40,000 rupees, balance 60,000 he is not paying me. Whatever 60,000 that he is not paying me, that I can recognize as expenditure, because already in GST sales I recognized 1 lakh income. Out of 1 lakh income, only 40,000 is realized and balance 60,000 is not realized. So in order to claim bad debts as expenditure, whatever the bad debts amount is there, that should be initially recognized as income. So whenever bad debt amount is already recognized as income in P&L account on accrual basis, then subsequently if that amount is not realized, that whatever the amount that could not be realized and is already recognized as income is there, that is allowed as expenditure. So there is precondition. If you want to claim bad debts as deduction, there is a condition. It should have been taken into account in computing the income of the SSC. That means at the time of computation of income, already bad debts should have been considered in the income, but those bad debts amount could not be realized. Then only bad debts is allowed as expenditure. Best example is credit sales made and amount is not being realized from the debtor. Are you able to understand? So the debt should be incidental to business or profession. That means what? Personal nature of bad debts are not allowed as deduction. Even in business also, there are some conditions. What are those conditions? Whatever the bad debts amount is there, that was already recognized as an income. Only if it is already recognized as an income and if it is not realized, then only whatever the amount that could not be realized is there, that is allowed as expenditure. Second case, your main business is lending of money. If your main business is lending of money, even though amount is not recognized as income, still whatever the amount that could not be realized is there, that is allowed as bad debts. So in case of money lending business, even though bad debts amount is not recognized as income, still it is allowed as expenditure. But in case of other businesses, whatever the bad debt amount is there, that should be previously recognized as income on accrual basis. Only if this bad debt amount is previously recognized as income on accrual basis, then only this bad debt amount, as it was not realized, it is allowed as expenditure. So precondition, what is the condition? It should have been taken into account in computing the income of the SSC, and such debt is written off or in any earlier previous year, or it should represent the money in the course of business of banking or money lending. The debt must be written off in books of accounts. Another thing is, see, there are two books of accounts that are maintained for company purposes. That means for accounting purposes, separate books are maintained. For tax purpose, separate books of accounts are maintained. In company related or normal books of accounts, the debtor account should be written off. Only if the debtor account is written off, then only as per income tax books of accounts also, that amount is allowed as bad debts. That means precondition is bad debt should be written off in accounts, company books of accounts. If bad debts are written off in company general books of accounts, then the bad debts will also be allowed as expenditure in income tax P&L account. Are you able to understand? Good. Only bad debts are allowed as deduction. Provision for bad debts are not allowed as deduction. Provision for bad debts not allowed as deduction. Bad debts must be in revenue nature. I told capital nature of bad debts are not allowed. Debts of a discontinued business not deductible. See, once the business is discontinued and after discontinuance of business, if there are any amounts that could not be realized, bad debts, those are not allowed as deduction. Once you claim bad debts as expenditure in current previous year, you have written off bad debts. After writing off the bad debts, in future there is recovery of bad debts. Recovery of bad debts is taxable as income under the head Pgbp. For example, I am into practice. I have done one work to the client. The worth is 50,000 rupees. Client paid only 10,000 rupees. Client is not paying 40,000 rupees. I have written off bad debts. 40,000 rupees I have written off bad debts. After 2 years, I closed my practice and I am into employment. When I was doing employment, there was recovery of bad debt 40,000. When this 40,000 came, am I still in practice? No, after 2 years I am in employment. When I was in employment, there is recovery of bad debts. At the time of recovery of bad debts, I am not doing practice. See, in the year of recovery of bad debts, even though business is not continued, even though business is closed, still recovery of bad debts are taxable in the year in which they are recovered, irrespective of whether the business is continued at that time or not. Okay. You can see here whether or not the business or profession in respect of which deduction has been allowed is in existence at that time. That means irrespective of the existence of the business, whatever the recovery of bad debts are there, they are taxable as income in the year of recovery. Next, family planning expenditure. Any amount that is spent educating employees about family planning, that expenditure is allowed as deduction. But family planning expenditure deduction is allowed only to company SSCs. That means for normal SSCs, family planning expenditure is not allowed as deduction. Only, see, in examination, in sole proprietor question, he will give family planning expenditure. Don't claim it as deduction, disallow it, because for individual, family planning expenditure is not allowed as deduction. Only for company, if it spends any amount educating the employees about family planning, that expenditure is allowed as deduction. With regard to family planning expenditure, not only revenue expenditure, capital expenditure is also allowed as deduction. But capital expenditure is allowed as deduction over a period of 5 years in 5 equal installments, just like VRS expenditure. Is it clear? And whatever the tax treatment for unabsorbed depreciation is there, same tax treatment is also there for unabsorbed family planning expenditure. Securities transaction tax. See, whenever securities are sold through or transferred through recognized stock exchange, then securities transaction tax will be levied. I am a chartered accountant in practice. I purchased shares. I am holding these shares are as capital asset. My main business is not buying and selling of shares. I am holding shares as capital asset. When I am holding shares as capital asset, capital gains head gets attracted. So even if I pay any securities transaction tax, as per capital gains provisions, securities transaction tax is not allowed as deduction under the head capital gains. So whenever you are holding securities as capital asset, securities transaction tax is not allowed as expenditure. But whenever you are holding securities as stock in trade, then securities transaction tax is allowed as deduction under Pgbp head. My main business is buying and selling of shares. As part of the business, I am paying securities transaction tax. That is allowed as expenditure to me under the head Pgbp under section 36 clause 1 subclause 15. Next, commodities transaction tax. Generally, commodities transaction tax is required to be paid at the time of transfer of commodity derivatives. I am holding commodity derivatives as capital asset. If I hold commodity derivatives as capital asset, whatever the commodity transaction tax that I am paying, that is not allowed as deduction under the head capital gains. But if I pay if I am holding commodity derivatives as stock in trade, then whatever the commodity transaction tax is there, that is allowed as deduction under the head Pgbp. Is it clear? Next. So whatever section 30 to 36 expenses are there, they are specific expenses. There are certain expenses which are not covered under section 30 to 36. Audit fees, our expenditure is there. Did we see audit fees from section 30 to 36? No. Transportation expenses are there. Telephone expenses are there. Printing and stationery expenses are there. Are these expenses covered under section 30 to 36? No. So if you go on writing expenses, numerous expenses are there. So that's why in law, whatever the specific expenses are there, for specific expenses, separate provisions are written. Those expenses which are not covered under section 30 to 36 are there. Remaining all expenses are allowed as deduction under section 37. So 37 is a residuary section which allows deduction for remaining all expenses subject to satisfaction of these conditions. So if you want to claim any expenditure that is not covered under section 30 to 36, all these conditions are required to be satisfied. Only if these conditions are satisfied, then only such expenditure is allowed as deduction. First, expenditure should not be covered under section 30 to 36. Why? Because if any expenditure is already covered under section 30 to 36, special provisions are there as per those sections. Then as per those sections, whatever the rules are there, as per those rules, expenditure is allowed. So if any expenditure is already covered under section 30 to 36, such expenditure is not allowed as deduction under section 37. Second condition, expenditure should be incurred after the business was set up, because before business setup, if any expenditure is incurred, that is preliminary expenditure. For preliminary expenditure, separate section is there, 35D. So that's why preliminary expenditure is not allowed as deduction under section 37. Expense should not be in nature of capital expenditure, because if it is capital expenditure, we will capitalize it, we will recognize it as asset. That's why if expenditure is capital in nature, that is not allowed as deduction under section 37. Only revenue nature of expenses are allowed as deduction under section 37. Expenditure should not be personal expense. I already told you, personal nature of expenses are not allowed as deduction. Only business related expenses are allowed as deduction. Expenditure should have been incurred in previous year. So only if the expenditure belongs to current previous year and it is incurred in current previous year, then only it is allowed as deduction in current previous year. Otherwise it is not allowed. Expenditure should be in respect of business carried by the SSC. I am quite often saying only business related expenses are allowed as deduction. Expenditure should have spent wholly and exclusively for the purpose of business. Expenditure should not have been incurred for any purpose which is an offense or is prohibited by law. See, if any penalty is paid, penalty is also expenditure, but that expenditure is not allowed as deduction under the head PGBP. Let's say I am into transport business. I have 20 lorries. I do transportation work. For that I earn money. One of the driver, he is not having license. He took lorry onto the road. Police catched him. Police levied penalty of 10,000 rupees for that lorry. Employer paid 10,000 rupees penalty. This 10,000 rupees, why it was paid? Because transport rules are not followed. For violating Motor Vehicles Act, I paid 10,000 rupees penalty. That is expenditure to me, but that expenditure is not allowed as deduction under the head PGBP. So if any amount is paid for violating any law, that amount we call as penalty. Penalty is not allowed as deduction under section 37. But if penalty is in the nature of compensation, so if penalty nature is compensation, then it is allowed as deduction. I have to pay GST amount to the government in the month of May, but I paid in the month of December. Why? I did not have money. I have done credit sales. Customer did not give money. If customer do not give GST amount, how can I deposit to the government? I cannot deposit to the government. So as per rule, I have to pay GST to the government in the month of May. But May I did not pay. June, July, August, September, October, November, December. 8 months after I paid. 8 months after customer gave money, that money I paid to the government after 8 months. Now for these 8 months, government lost interest, right? So government levied interest on me. So for these 8 months, I paid GST. Along with GST, I also paid interest on GST. That interest on GST is allowed as expenditure to me. I am paying 8 months interest for violating GST Act. As per GST Act, I have to pay in the month of May. I violated and I paid in the month of December. For violating the law, for 8 months I am paying interest. But why government is collecting this penalty interest? Because government has to compensate its interest. So if any penalty is paid and if that penalty is in the nature of compensation, then it is allowed as expenditure. But general penalty is not allowed as deduction. For violating any law, if any penalty is paid, not allowed as deduction. If penalty is levied to compensate the interest expenditure of government, if penalty is in the nature of compensation, then it is allowed as deduction. Yes, CSR expenditure as per section 135 of Companies Act 2013, there are conditions. If those persons who are satisfying those conditions, those companies are required to spend certain amount for CSR, corporate social responsibility. Whatever the CSR expenditure that is spent by the company is there, that is not allowed as deduction in P&L account under the head PGBP. Next, if any advertisement expenditure incurred to do advertisement in any political party souvenir, pamphlet or calendar, that advertisement expenditure is not allowed as business expenditure. See, in political party calendars, pamphlets, if you give any advertisement, whatever the amount that you are giving for that advertisement, that is considered as political party contribution and it will not be considered as business expenditure and it is not allowed as deduction under the head PGBP. So any amount given to political party for advertisement in political party pamphlet or calendar is not a business expenditure. But that amount SSE can claim as deduction under section 80 GGB or 80 GGC under chapter 6A deductions. There are some important points with regard to section 37. Let us see. See, for bypass surgery of a professional, if any expenditure is spent, that expenditure is not considered as business expenditure because first he has to live, then only he can do the business. So without surgery he cannot live. So that's why whatever the amount that is spent on bypass surgery of professional is there, that is considered as business expenditure. Sorry, that is not considered as business expenditure and it is a personal expenditure. So plastic surgery expenses of TV or news reader, obviously their main business is reading the news, they have to look good. So for that, if they get any surgeries and all done, even cinema actors also, for any movie, if they get any cosmetic surgery and all, that expenditure is a revenue expenditure and is allowed as deduction. So subscription to gym by an actress. So for movies, if they in order to get prepared for a movie, if they subscribe to any gym, whatever the expenditure for gym is there, that is allowed as deduction, because it is mandatory for them to go to the gym to maintain that physique and all. So for that, if they pay any expenditure, that is also a revenue expenditure. All these are various case laws. Okay, in those case laws, whatever the judgments that are given, those are highlighted in brief in various points. So electricity expenditure, telephone expenditure, postage expenditure, that is also allowed as deduction. Expenditure incurred by employer on training of apprentices. Articles for our offices, CA offices, articles will come, right? So for articles, if any stipend is given, that is a business expenditure and is also allowed. Our fees, audit fees is also a business expenditure, right? That is also allowed as deduction. Entertainment expenses incurred is allowable as expenditure. If you go to big corporates, Infosys and all, within the campus only they have playgrounds, indoor playgrounds, outdoor playgrounds. So for employee entertainment, they do spend certain amount of entertainment expenses. They are also allowed as deduction. Expenditure on temple in the factory for recreation of employees, that is employee welfare expenditure, that is also considered as business expenditure. Royalty paid by SSC for use of another's trademark, nothing but royalty. See, if any royalty is paid, and if that royalty is paid with regard to business purpose, that is also allowed as deduction. Legal expenses to defend or maintain the title of an asset of the SSC's business are allowable. I am a chartered accountant in practice. One of the student filed a case against me. Caumasankar sir is not a chartered accountant and he is portraying himself as a chartered accountant and he is deceiving all the students. Okay, so when he filed case on me, obviously I have to give reply, right? So I went to my lawyer, I gave my certificate of practice, I gave my membership number, all the required details, my CA final pass certificate, all these details I gave to lawyer. Lawyer went to the court, he defended my case and I won. Now here I defended myself. My main income is profession. So unless I defend this case, I will lose my professional income. That's why I have to defend my profession. For that I have paid some lawyer fees. I paid lawyer fees to defend my profession. That is also allowed as business expenditure. Legal and court expenditure spent for income tax or sales tax. See, income tax is not allowed as deduction. But with regard to income tax, if any appeal comes, for that if any chartered accountant goes, I need to pay professional fees, right? So if any expenditure is spent with regard to income tax appeals or sales tax appeals, that professional fees is business expenditure and is also allowed as deduction. And legal expenses for making agreements, various deeds. See, for drafting, professionals will charge expenses. Those drafting expenses are also allowed as business expenditure. Expenditure incurred on Diwali, sweet packets will be given, right? So whatever the expenditure that is spent on Diwali, New Year is there, those are also business expenses and they are allowed as deduction. Compensation paid to an employee for injury during duty. Obviously, see, he is working in the factory and certain something happened to him, some little bit of accident, and it happened in the office factory only. For that, employer got treatment of employee. That is obviously business expenditure and is allowed as deduction. Expenditure on employees' welfare, that is also business expenditure allowed as deduction. Expenditure on incurred on issue of shares or debentures not allowed. See, for the purpose of issue of share capital or for the purpose of issue of debentures, if any expenditure is spent, the nature of expenditure is capital in nature. That's why expenditure on issue of shares or debentures is not allowed as deduction. Remaining provisions we will see in next part. Thank you.